What's up, you guys? It's Steve here, and let's talk about a potential housing market crash right now in 2022, because it seems like everywhere you turn, you're hearing about a housing market crash right now. And I've got some good news for you, and I've got some bad news. Now, the good news is if there's a crash, you could finally afford a home in the United States. Now, the bad news is if you just bought a home or if you're living in one right now, the value could be coming down substantially. Now, how bad is this going to be? How long is it going to last? Is there actually going to be a crash? Well, in today's video, I'm going to be taking a look at the data with you so we can get a good handle as to what we can actually expect to see. And we're going to be looking at this on two different levels. First, on a national level, so that way we can see what has historically happened, what happened with 2008 and the Great Recession across the nation, and what we can expect right now. And also, we're going to be looking at a couple different local markets, because as I've let you know here on the channel, all real estate markets are not created equal. What they will experience, say in Los Angeles, California, where the cost of a home, the average is over $1 million, it could be a little bit different from what they experience in, say, Cleveland, Ohio, where the average cost of a home is roughly $120,000. So all real estate markets are not created equal. What you might experience in your own local market could be totally different from what I experience here in Houston, Texas. So we're going to be taking a look at the data and also discussing all of the different causes of why people are concerned right now, as prices are at record high, supply is at record low, and we're hearing the Federal Reserve is cranking up those interest rates, which we're hearing could cause a stall in the market. Now, we will see. I'm going to get into all the details for you in this video. Now, before we dive in, if you could do me a favor, crank up those like button numbers for me. That was really bad. Just go ahead and smash the like button for me. I would appreciate it if you appreciate the content. Thank you so much. Also, if you want to see more videos like this about what's happening with the real estate market, our economy, finances, growing wealth, starting businesses, hit the subscribe button, turn on that notification bell. Any specific questions for me, shoot them to me in the DM on Instagram at SteveRam3. But with that being said, you guys, let's go ahead and dive right in. All right, so let's go ahead and dive into the data. And we're going to be taking a look at what unfolded back during the 2008 Great Recession, that massive real estate collapse that unfolded. We're going to be taking a look at the extent of that. We're going to see two things that we want to focus on. And that is going to be the intensity. How bad did things actually get? And the duration. How long did this last? Now, if we take a look at that, it'll give us a little bit of a frame of a reference of what we can expect to see unfolding now. And we got to ask yourself, do you think it is going to be as intense as what unfolded back then? And do you think it's going to last as long as what unfolded back then as well? Now, also, there are different things that are sparking the potential correction coming right now than what unfolded before. As you guys know, they had ninja loans back then. No income, no job or assets required. Just pretty much if you could fog a mirror, you can get a loan. So a lot of bad lending practices were taking place back then that aren't necessarily happening right now. So a little bit of a different situation, but let's take a look at what unfolded. This is Fred economic data from St. Louis Fed. So this is on a national level all across the nation. Now, of course, it's going to vary on your local market. What's going to be unfolding, like we mentioned in Los Angeles, California, it could be totally different, and it likely will be different than what you might experience, say, in Cleveland, Ohio. The correction might take place at a different time and to a different extent. Some places might feel it severely, other places might not feel it at all. But this is what unfolded on a national level. So you can see right here that Q1 of 2007 was the peak of the real estate values right before things started coming down. And they were at $322,000 for a cost of an average house in the United States. Now we can see that Q1 of 2009 was the bottom. So over the course of 2 years, the real estate market just kept going down, and it went down to $257,000, which is almost exactly a 20% decline in value. So during that crash that was sparked by those ninja loans, bad practices, and what actually unfolded due to the real estate market, we saw a 20% drop in values. So now you have to ask yourself, with everything that's unfolding today, do you think that the intensity, the severity of what is coming is going to be as bad as what we experienced back then with the Great Recession? Now, let's take a look at the duration. How long is this going to last? So it took 2 years for it to bottom out. how long did it take to recover? Because if you're thinking about buying a house right now and things start falling, you only lose money if you sell. But if you're planning on staying in that house a while, you might be able to weather the storm and come out on top. So how long did this last? Well, as I mentioned, the top was Q1 of 2007, $322,000 for a house. So if you buy a house right now and you think you're at the top, well, it took 5 years for it to get back up to $320,000 in Q2 of 2013. So if you're thinking about buying a house right now, you're okay with the mortgage payment, you're not planning on going anywhere, and you think it's probably going to last about the same amount of time or maybe even less, and you're planning on staying in there over 5 years, chances are you're going to be just fine. That is a frame of reference from what we had seen before. All right, so let's take a look at a couple different markets in the United States because, as I mentioned, all real estate markets are not created equal. We're going to be taking a look at Los Angeles, California, Cleveland, Ohio, and right here in Houston, Texas, to give you an idea of how some of these markets differ pretty dramatically. So first off, let's take a look at Los Angeles, California, where according to today, Redfin, the median sales price is over $1 million, and this is 13.5% increased year over year, substantial increase in price. And you can see how it's been going up over the course of the last 5 years. And the number of sold is at 2,201, which is actually slightly down, almost 18.5% year over year. So a little bit of slowing on the number of sales. And how many days on the market? Well, we are at 30 days on the market, which is actually down year over year, 7 days. So this is still a seller's market and the values are still up, but we are seeing a little bit of a slowing. But we will see, because right now the concern is the increased interest rates, which we're going to be discussing here in just a second, which the impacts unfold a couple months later. So if we are currently getting shocked in the market right now, we'll actually see it delayed a little bit down the road. Now, let's take a look at Cleveland, Ohio. You can see here the median sales price today, according to Redfin, is $124,000. This is up just 1.2% year over year, just a 1% increase from last year. So you can see this is a little bit of a more stable market. The prices aren't skyrocketing like we saw in Los Angeles. But you can see over the past 5 years, it's been going up pretty nicely. Every year going up a little bit. Number of homes sold, 474, and this is actually up 17.3%. So things are going strong in Cleveland, Ohio. You can see just increasing year over year, and median days on market is actually declining 17 days on the market, and you'll sell your house in Cleveland, Ohio. So Cleveland is just going strong right now. So you can see the differences between Los Angeles and Cleveland, Ohio at this present time. And here in Houston, Texas, take a look, you guys. Median sales price $340,000, similar to Los Angeles. 13.7% year over year increase in sales price. So those prices, they're going up quick. Now, also, it says the number of houses currently sold is 3,254, and this is actually up as well, about 1%. So there's no signs of slowing right now in Houston at this time either. It's kind of stable, but we are not in the decline like we saw in Los Angeles. And median days on the market, 13 days on the market, and you will sell your house in Houston, Texas. And this is actually down from 5 days. So things are going pretty strong right now in Houston, Texas as well. So there's a look at 3 different markets across the U.S. and you can see how they vary substantially in price, price increase, days on the market, and the number being sold. All right, and now let's talk about what we could potentially see in the form of a crash and what is causing all of this to potentially unfold. So, as you know, right now, prices are at record highs. We've never seen them this high before, and that is because we have supply that is down significantly. We have supply chain shortages for materials, for building more homes, and also we have inflation at a 41-year high due to everything that unfolded with the pandemic and stimulus and our money system. Now, as a result, the Federal Reserve has decided that they are increasing interest rates, and we're hearing at a pretty rapid pace. They just increased it by 75 basis points. We have not seen an increase that high in over 31 years. So a lot of people are becoming very concerned because of a rule that they call the 1% to 10% rule, which is as interest rates increase by 1%, you lose about 10% of your purchasing power and your mortgage becomes less affordable. So what you could have bought before, decrease that by 10% for every 1% of interest rate increase. So the question becomes, is that going to cause the value of homes to tank If they increase it, say, by 3%, are we going to see a 30% decline in the real estate market? Well, my answer to you on that would probably be no. I don't think we're going to be seeing a substantial drop in the prices. Now, hear me out on this, and also know that I think it's going to affect different markets differently. There could be corrections in some markets, but in some, it's probably not going to hit them as hard as you might think. And here is why. Let's just make a simple example for this, talking about the 1% to 10% rule. Now, let's say that you've got a house on the market for $300,000 and you've got a ton of buyers ready to buy your home. Well, all of a sudden, the Federal Reserve cranks up the interest rates by 2% and they lose 20% of their purchasing power. So they were able to buy $300,000 worth of home. Now it goes down to $240,000. They're all priced out and you have no buyers, right? Well, not necessarily, because there was a ton of buyers up at $400,000 and now their purchasing power has dropped down to $320,000 that they can afford for a home, and now you've got a whole new set of buyers ready to buy your home. Because I don't think people are just going to walk away. They're still going to want to buy. They're just going to have to buy at a lower price. And we saw that the average cost of a home right now is around $500,000. So if you're around that average somewhere, chances are you're going to be pretty good, because there's going to be people higher and there's going to be people lower. They're all just going to shift down in their purchasing power, what they're going to be able to afford. Now, this is going to probably, though, price out some of those at the very bottom. They're suddenly not going to be able to afford what they thought, and they might get priced out. But this also might apply more pressure to those homes in those lower price range, as there's going to probably even be more buyers going down further in what they can purchase. So it might not impact all the different levels of pricing the same either. So those at the top, too, that are selling luxury homes, it might price out some of those that are using loans to get those homes. But usually those that are buying luxury homes, a lot of times they're buying cash as well. So that might not hurt them as much. And also, we saw a K-shaped recovery from the pandemic, which means the rich that are buying luxury homes, they actually got richer. They've got a lot more cash. They made a lot of money in the stock market and cryptos. And if they're sitting in cash, they made some good moves. They might throw it into the real estate market. Now, if they've got it sitting in crypto and stocks right now, they're probably not doing so well. But what I'm saying is that overall, I don't think this might cause as severe as an impact as is being implied at this present time. And of course, the last factor that affects all of this is the Federal Reserve. Now, keep in mind, over the course of the last decade or so, the Federal Reserve has been doing everything they can to keep this market propped up, to try to recover from that Great Recession. The last thing they want to do is cause this to tank. So the other factor is intervention. If we go into a place where there is an official announcement that we have entered into a recession, there's also the possibility that the Federal Reserve might stop cranking up those interest rates and might actually bring them down to try to balance things out. And if we see that, we could see the opposite happen. We could see the surge continue. So right now, we're going to wait and see what the Federal Reserve does, and we're going to see how all of this impacts it. As I mentioned before, when they change the interest rates, the reaction to the market takes place a couple months later. So we're going to see, but at this present time, I got to tell you, I think there could be a correction. We could see it more severe in different markets across the nation, but I don't know that it's going to be as severe or as dramatic as people are saying, and I don't think it might be as bad as what we experienced in 2008. So that's my thoughts. That's the analysis. Let me know in the comments down below what you think. Do you agree with me? Do you disagree? There's the data for us to get a handle as to what we can expect to see. I don't necessarily think it's going to be as dramatic as what happened in 2008, but there could be a potential correction. And if you're planning on buying a home right now and you can afford one, and you're planning on staying in it for at least 5 years, I don't necessarily think it's a bad move. I might be wrong. This is all just for entertainment purposes. Don't take this as financial advice. But also, I'm an investor and I'm still buying right now. And I figure too that if the values start going down and the interest rates start going up, I'm still going to be buying, because I think the prices overall will go up with time. Eventually, the interest rates will come down, and you could always refinance whatever it is that you purchased. So that is what's going on, you guys. I will keep you up to date. We'll see if there's going to be a crash or not, and if there is, or there's not, I will do follow-up videos on real estate so you know how to navigate these markets. But with that being said, you guys, thank you so much for joining me, and I will catch you in the next one. Again, if you've made it this far and you haven't already, don't forget, hit the like button for me. If you want to see more videos like this, hit the subscribe button, turn on the notification bell, follow me on Instagram at SteveRam3, and with that being said, I'll catch you in the next one. Take care. God bless. This is Steve.